So you're all in teams. You are in a competition with the other teams. Okay. All right.
Dylan, you're like the smartest one.
What we're gonna do today is what I did today is we're going to talk about. We're gonna have you. You guys are gonna make investments in these stocks. You don't know what the stocks are. I've masked them. So you're going to know some statistics about the stocks, but you don't know what the companies actually are. These are real companies, and it's all real data. Okay? But the first thing I want to do is go over the homework real quick.
I did that just now.
Homework was hard.
All right, so we can. Let's just talk about the different, like, what was difficult with the homework. First of all, the inflation stuff. I thought that was actually kind of cool because people pick different things. That's one of the more interesting things was somebody picked oil.
I picked milk.
You picked milk. And what was the inflation rate of milk?
33% increase.
Over 5 years?
It said the year you were born to the year you were.
Oh, okay. So like 13 years?
Yeah.
Okay.
Like 2012 to 2026.
So it went up. It went up by a third in 13 years. So how much did that end up working out per year? You can't do 33 divided by 13, right? Because that's not how we do compounding math. How do we do it?
It's 33 divided by 13 times.
Well, what is the Declan? How are you? Come on in.
Good, are you?
Declan, join. Let's do this. Declan, I'm gonna have you come up here and,
You can join Hunter.
You sit right in the middle there. You'll join that. You'll join Hunter, Liam, and Ezra on the team. Okay.
What time are we done, Coach?
About 9.
All right.
Yeah.
Thanks.
Yep. So we had. If you went up 33% in 13 years, so that would be 1.3. Okay. Raised to the 1/13th power, right? That's how we how we cut it. That's just to get the compound annual growth rate, right? So who can do that? Anybody have a calculator? 1.33 to the 1/13th power.
$1.0997.
One. That doesn't sound right. 2.2%. That sounds right. That sounds more right. So milk went up. Milk went up by 2.2% a year. Okay. So which is about kind of in line with what the inflation rate for almost everything has been. I have a. You're all getting a little older, so this is a good one. When 30 years ago, when I went to college, like riding a dinosaur, college cost $30,000, okay, a year, okay. It's about $90,000 a year for a private college today, in 30 years. Who wants to compute the annual compound inflation rate on the cost of college?
How many years ago?
30 years ago. This is 2026. I entered college in 1996, exactly 30 years ago.
Wait, 30 years ago?
Exactly 30 years ago, I entered college. Yeah.
19.
So what was the compound annual inflation rate?
37.3%. 37.3%.
That's way too high.
Sorry.
Wait, what?
Sorry, sir.
Oh, 30.
So how much did it?
3.7%.
3.7?
Yeah.
Is that right?
3.7? What was the formula you used to compute it?
I did the
30,000 times some variable plus 1 to the
and then
million.
parentheses 1 plus r to the power of t and then.
Okay. And so what was the number that you raised to the power of 1 to the 1/30th power? What was the number you raised to the 1/30th power? 3. Correct.
Nice!
So 3 to the 1/30th power. So college has went up by a little over 3%. It's actually not much faster inflation rate than milk has been, weirdly, which everybody talks about how much college costs have went up, but it's not much more than milk. Anyway, Inflation is kind of a common thing. The cost of everything is like, you never hear your parents say things like, "Oh, gas used to cost this," or what, you used to be able to go to the movies for, $3, or when I was in college, the job that I had paid me $5 an hour. Like, all these numbers sound very small to you because of inflation has made everything, all price levels kind of go up over time. So that's the inflation. That's the inflation question. This is a big question, an important one. Did the fee impact? If you have money that grows at 8% a year for 40 years, okay? Actually, pull this up. Here. Okay. So this is kind of crazy, but the question was, if you put in money, invested every month, if you guys invested 100, you know what? Let's actually we could close our laptops. We don't need them. Like we'll open them later, but we don't need them. They're super distracting. So if you invest $100 a month and it grows at 8% a year, the monthly growth rate is 0.64% a year. Okay, I mean a month. It's growing. It's compounding every month, right? After 40 years, if you put in $100 a month, you will have put in. If you put $100 a month for 40 years, how much money have you invested?
4,000.
What?
40,000.
4,000.
How did you get 4,000?
Yeah.
You add two.
$100 a month. I'm sorry.
$100 a
Oh,
month.
a
$100 a month
You didn't say
for
that.
40 years.
Well, now I'm regretting. 40 is 48.
208,000.
48,000.
48,000.
That sounds right. 48,000,
Let's go.
right? It's 1,200 a year for 40 years. Okay. You've invested $48,000. You will have at the end of 40 years, $324,000. Okay.
That's a lot.
Okay. If you pay 1% a year in fees to somebody to manage your money for you, which a lot of people do, you will only end up with $248,000.
Also take that.
So that 1% that you gave to somebody to manage your money cost you $75,000 over the course of the 40 years. And the crazy thing is, it cost you $75,000. You only invested $48,000.
Okay.
It actually cost you more than the amount of money you put in. You've paid this manager of your money more money than you actually invested. It sounds so small. It's just a 1% fee. But when you compound it, it becomes $75,000 over the course of all that time. If you had taken that money and just invested it there's a lot of, you can put your money in a fund and the fee is very small, where instead of 1%, you pay 0.03%. So instead of growing at 8%, you grow a little bit less at 7.97%. But you end up with pretty much the same amount of money, right? It only costs you $3,000 over all that time, right? So this is just kind of a reminder that there is a lot of people who are spending a lot, and it costs them. It doesn't sound like much, but it costs them a lot over the course of their life. And if you flip it, there are a lot of people collecting this fee that are getting very, very rich off of other people's money. Okay, so just so you're aware, but I just want you all to be aware of the impact of that 1%. Sounds small, but it ends up costing you, 23% of your terminal wealth here. Okay, so anyway, that was the point of that question. Why I thought it was important. Okay. PED. So this one I'll just give a shout out to Shane. This was super cool what he did. So with this question, the idea, what we were trying to do is just look at if earnings, it's kind of like we talked about the Zoom example last time. You could have your earnings could grow a whole bunch, but if the multiple on the earnings falls on your company, you'll actually your investment won't do very well. if we look at these, this is actually pretty cool that Shane broke all this out. Well, Apple, whatever Apple was earning, it was trading up just about 20 times a share. So remember, like, let's say Apple was earning $10 a share, its stock price would have been $200 back then. Its multiple went to 32 times in the last 5 years, which meant that you ended up making, 100% return on your Apple stock. Basically, your Apple stock doubled in the last 5 years. But the crazy thing is its earnings only went up 5% a year. Like, Apple has only made a little bit more money. It's actually only a little bit more than inflation, if you think about it. Like, they've only made a little bit more money every year, only 5% growth, but the stock is doubled. And it's all being driven by the fact that the multiple on Apple stock has increased. And if you look at all these companies, it's actually kind of interesting. It's a pretty similar story. The multiples on all these companies has just grown, which means that these companies have all just gotten more expensive per unit of earnings. The one here that's kind of really pretty crazy is Johnson & Johnson, whose earnings growth has only grown 1% a year. It's like less than inflation, and yet you still would have earned 60% on owning this stock because the multiple had went up so much. So the point here is that it's not just the earnings changing that affects what's going to happen to your investment. It's how much the sentiment around that stock, how much people are willing to pay for a share of earnings. So one that was interesting, another one I thought was kind of interesting was like JP Morgan was the that's a big bank. That was the cheapest stock. Does everybody understand why JP Morgan was the cheapest of these stocks? Hunter.
Because it had the least price to earnings ratio.
The lowest price to earnings ratio. It has the lowest multiple. Can somebody tell me what, first of all, just a reminder, if your earnings multiple is, let's call this 20, what's your earnings yield? How much do you expect to make a year on that stock?
120%.
No. That would be amazing.
That's crazy. You'll get it next time.
No, it's not gonna, so if I buy something for $20, okay, and it makes $1 a year, how much do I earn in a return? 5%. I earned $1 over a $20 investment. I earned 5%. So when my PE is 20, my earnings yield is 5%.
So the reciprocal?
So it's a reciprocal, right? So JP Morgan, we can call that call it 12 and a half because it makes it easier. If my PE is 12 and a half, what is my earnings yield? 1 over 12 and a half. It's 1 over 12 and a half would be about 8, right? Yeah. So this is 8% earnings yield per year, right? So it's the cheapest stock. You earn the most return from buying the stock. You end up not making, it ends up being the worst performing stock, actually. You made 48% return, and it's because its earnings did not grow, earnings didn't grow very much, and the multiple only increased by about 25%, from 12 to 16, okay? So, again, I'm just pointing out the two big forces that will drive a stock's return, which is its actual earnings, and then how much people are willing to pay for those earnings. Oh yeah, this one, the answer's right up here, but the question was, if you had $10,000 and you were investing it for 5 years at 6% a year, it's kind of like, would you rather earn 6% a year on 10 grand, or would you rather earn 3% every 6 months? Compound at 3% every 6 months. What's better?
3% every 6 months.
3% every 6 months, right? Because 1.03 to the 10th power is a little bit larger than 1.06 to the 5th power. And so the point is that you want to compound as frequently as possible. Go ahead.
Can you like calculate like average inflation per year?
Yes. So the way that was what we kind of did before. So if you take the ending value of something, like that was the college example. So the ending value of college is $90,000 a year. The starting value is $30,000 a year. If you take the ending divided by the starting,
Oh, okay.
right? That was the 30. Sorry, the 3. and then you raise that to 1 over the number of years power.
Okay.
So that would, if you do 30 to the 1/3 to the 1/30th power, to the 1/30th power, that sounds a little weird. It's about 3%. Yeah. Okay. Cool. All right. So analyzing stocks. So there are a lot of different things that we could talk and think about when evaluating stocks, but there's different categories of numbers. We're not going to go into all this stuff, but there's like how much is the company growing? It's your revenue growth, right? Actually, we had an example earlier today. Zach pulled up an example that had shown that Roblox revenues were growing 50% per year for the last 5 years, but its earnings actually went down and went negative. So who thinks they know what happened? Hunter, go ahead.
They're like all the AI companies right now are investing in future like databases and stuff, so they can have better profitability in the long run.
Okay, so they're spending a lot of their cash flow that they're getting, they're reinvesting it back. So what happens is like their net earnings are not going up because they're taking the cash and they're plowing it back into the company. So that's a possible reason. What's another possible reason that their earnings fall? Zach?
They're making a lot of money, but not enough to actually be profitable.
Yeah, their costs are too high. Their costs might just be too high. I said, I was giving the example before, but if you want to get your revenue to just grow as much as possible, you could just sell dollar bills for 99 cents, right? You will get all the customers. If I go and I open a hot dog stand, and if I sell hot dogs for 50 cents a hot dog, well, I'm going to put all the other hot dog stands out of business, but I'm not going to make any profits, right? Like I'm going to get all the market share, but I can't cover my costs if I sell a hot dog for 50 cents. So
They're running at their competitors to make it stuff a lot cheaper, so they could get monopoly.
they could, if they can survive long enough to be the last company standing. There's a word for that actually. It's called they call it predatory pricing. This is by the way, this is like a big issue with Chinese companies. The Chinese companies create all these amazing products. They sell all this stuff, but a lot of them are not profitable because they're selling stuff too cheap, right?
Is that what like Dollar Tree does? Except that they make like very small amount of profit.
Dollar Tree, those companies are, I think, quite profitable.
Yeah.
So they're not selling $1 for less than $1. I think they are
Yeah,
making.
yeah.
I think they are making a positive margin on the things that they're
Like
selling.
A small positive.
A small positive margin, and then they're
But
doing
they're
it.
doing a lot of it.
Doing a lot. They're making the money on scale. What's it?
Is Costco actually profitable right now?
A Costco hot dog has been $1.50 for 40 years.
So
Don't mess with
Costco can sell their hot dogs below cost because it's a very small percentage of their revenue, right? But Costco, Maddox studied Costco in his homework, which was very cool because he noticed. So Costco had a super low margins.
Yeah.
Super low margins, right? But where does Costco make up a lot of their money? It's not on what they sell; it's on their memberships, right? Go on, Hunter.
So I saw this thing that the stores lose money on TVs so they can make money on subscriptions and stuff. Ooh,
Yep.
I also know.
So the TVs in this example, the word for that is a loss leader. So you have a product, or think about Black Friday, where they sell products for really, really cheap to get you in the door. The hope is that you will spend a whole bunch of money on more higher margin items. Daniel.
Printers, they sell their printers for super cheap, but then they mark up their ink a ton.
That's
Because
right.
The printer can only use one type of ink.
That's right. But that's a razor blades has also historically been really profitable business. But it's
Like
they
the
sell the
spears?
razors really cheap. They sell the stick cheap, and then the actual razors because they know that you have to. It's like a subscription business. They know you have to keep buying, right? So here there's different metrics, right? There's growth metrics, which is revenue growth, your earnings growth. There's your profitability profitability, this is the stuff where we talk about margins. You know, how much, when you sell something for $5, how much of the $5 are you actually keeping? What's the cost of the item? You know, this is like in school, if you're selling potato chips at school to other kids, and you know you're selling a bag for $4. If the bag only costs you $1, you have a 75% margin. Okay, so those are profitability ratios. This kind of comes back to the reinvestment. Once you make all this revenue, you have this cash. But what do you do with the cash? You could keep the cash, or you could give the cash to your shareholders, or you could take the cash and you could reinvest it. So that's another activity that happens with the cash, is that you can do research, you can do CapEx, is to like invest in new plants, open new stores. That's investment activity. Valuation is another kind of set of metrics. We've been talking about that. Price to earnings ratio, earnings yield is the inverse of that. There's an important one called free cash flow, which is if you make earnings, if you make a certain amount of earnings, that doesn't necessarily mean that you can spend those earnings, because free cash flow would be like, what do you have left after, let's say you have a plant and you make a bunch of money, but then every year you need to plow a bunch of money to keep it back into the plant so that it continues to work. Cash flow would be like what you have left over after rehabilitating the plant that you had been using up, okay? And then your financial health. Remember we talked before, if you have debt, you have to pay interest rate on the debt. If you make $10 million of profit in your company, but then you have to pay your bondholders $10 million in interest payments, right? That's not a very healthy company, right? Like, yes, it makes a bunch of money, but it needed to raise all this expensive, it needed to raise all this capital from investors, and it's costing them $10 million a year in interest, right? So the financial health of the company. The point of all this, all these metrics, this is all backwards looking. All of this stuff is data that you have about the past, but none of these numbers, not any of these numbers, are things that are actually known about the future. Everything here is only based on the past, right? And what are investments about? They're like about what is going to happen in the future. So all of this, you can learn all of this stuff, and people do, and they study this, but it does not mean that you are going to get things right exactly, because all of this is backwards looking. So somebody might be looking and saying like, hey, the profitability of this company looks fantastic. All these metrics, maybe they all look great, but then like there's a thing called AI, and it effectively means that every one of these metrics is going to get a lot worse for that company in the future. So again, this is just all about the past, not about the future. Go ahead, Zach.
Can I go to the bathroom?
Yeah, of course. Okay. This stuff here, this is like sort of about like what's going on in the market and stuff. We're not really going to pay any attention to this stuff in the middle, but like things like the like what the stock has been doing, and sort of like these technical aspects of a stock price itself, who's buying, who's selling. We're not going to focus on that stuff, but I just want you to know that there is this category of things that have to deal with that. The future, and this is what I'd say it's the hard part. All the stuff about the future is really hard, because this is the stuff that is about understanding the competitive landscape that the company exists in. Is understanding, do their customers have to switch? Like if you have a software that AI can do, the question is like, can you actually maintain your customers, or are they going to look and be like, I'd rather just use AI? I mean, what's interesting is, like, for example, you can make a tax software to file your taxes, right? With an AI software. Somebody could just vibe code a software that can do your taxes for you. But if you say, I'm gonna use that free software to do my taxes, how do I have any faith that they are updating the code along with the IRS laws, for example? So like right now, when you go and you file your taxes online with say like a TurboTax or something like that, they are going to, if they file it wrong, they're on the hook for it. They can have to fix it. So they're taking the liability for you. They're like absorbing risk for you. So that would be something that would protect. You might look at something like a TurboTax and be like, oh, they're cooked. AI is going to eat them. But maybe people are using it because, well, I know that this company is going to stand up for me if the IRS comes knocking and says you didn't do your taxes right. So it's not quite as simple as, hey, there's this alternative that can just do the same thing for cheaper. Because that alternative isn't necessarily going to provide all the same bundle of services that the other company is. But the point is that it's kind of hard to know, like and this is what all of the future is about, these things that we don't know. How big is the market for the thing? We're selling sneakers, how big is the market for sneakers? How is like nobody anticipated what Crocs was gonna do, right? Like Crocs was, like if you might look at Crocs and you see this funny looking shoe when it kind of comes out, nobody had any idea of how popular, and not just popular, how long lasting it was going to be. Like everyone thought like, oh, this is a fad, it's going to be over. What's the big thing right now? Zach asked me about the Neato. You guys all know about these Neatos? So yeah, there you go, like that right there, right? So these Neatos are, my understanding of these things is they're trading for like 30, 40 bucks in the on the secondary market, right? If you can find it in a store, it costs you what, $6? Something like that. So Zach said, oh, I want to buy the stock of the company that makes Neato and like sell it in a month because I think that this is a fad that's going to be over with. But think about what he's doing there is he's thinking about the future, right? He's speculating that the fad is going to be over. By the way, the company that makes them is not public.
Isn't speculation the reason why the 1920s
1929.
crash happened?
So speculation can lead to a crash when everybody is, well, the big thing that can lead to like markets dropping a ton is if everybody gets really, really excited and it's like borrowing money to buy stocks. Like if you go and you buy a stock and the stock goes down, you don't have to sell the stock. But if you borrowed money to buy the stock and the stock goes down, the lender is going to come to you and say, well, I lent you this money. You went and you bought a stock for $100. I lent you $50 of it. And then if the stock drops to $60, they're going to say, well, if it drops anymore, you can't pay me back. So we're just going to sell your stocks for you and take our money back that we lent to you. So what happens is you are forced to sell. They are forcing you to sell, right? Because they want to make sure that they're kept whole. Okay, so a lot of speculation on borrowed money is definitely something that can lead to a crash. Okay, so anyway, the past, present, the future. Okay, different categories. All right. I just want to talk about Amazon real quick before we hop into our game. Amazon is just because it was an interesting story. So I never invested in Amazon, and for 20 years, this ridiculous stock, which has been one of the most successful stocks ever, has just went up and up every single year, making all this money. And the issue was that if you looked at Amazon's earnings per share, it was always like zero. Okay, like the company was making no earnings. Its net income for many years was basically zero. If it's zero, your PE ratio is effectively infinite, right? The value of the company is as a multiple of its earnings is effectively some infinite number. It looks like a gigantic bubble in this stock, right? Okay. And the other thing is they had razor thin margins, right? What Amazon does? It sells things it doesn't make much profit on any item that it sells, gives you free shipping, all this stuff, right? So it kind of looks like a low margin business in the company, and that was everybody for 20 years. This company doesn't make any money, What really happened? The guy who founded Amazon, his name was Jeff Bezos, okay? Jeff Bezos basically reinvested every dollar that Amazon made into more business. They started building warehouses. They started building fulfillment centers. They started building AWS, which is like cloud infrastructure, which if you're Everything we're doing here lives on a cloud somewhere, right? They were investing in all of that stuff. So every dollar he's making, he's plowing it back into investing. So what happened is, when he does that, you don't see any cash in the company because it's taking all the money and it's doing what's called capital expenditures, reinvestment. It's called CapEx for short. So there's CapEx, then the value of the CapEx kind of like depreciates over time, and this crushes his earnings. So it doesn't look like the company has any earnings. But the thing is once AWS matured and once Amazon got bigger and it was slowing down how much it was reinvesting, it became very clear how profitable the company was. The profit was always there. They were making tons of money. They were just investing it all. And as the investment started to slow, you started to see the fruits of all that money they had been investing. So it was a company that had high operating cash flow, but its earnings were low because the earnings were shrunk by the fact that they were reinvesting, right? So, and that's the difference between your earnings and your cash flow is sort of like, that's why people will look sometimes at this thing called a free cash flow yield. They think sometimes it tells the truth about the company, where earnings can't tell the difference between a company that is reinvesting a lot and one that is not, but free cash flow doesn't lie. Okay, this is like what they're actually making on their operations, on their business, right? So this is kind of what it says down here. The net income is what the accountants say you earn, but your free cash flow is what you actually think you have left. So Amazon was a wildly profitable company that everybody thought was a bubble for 20 years. Okay. I won't go into this really closely. I really like Liam. I really appreciated this. This was super cool. This was Liam just calculating the profit margins for various companies, and you can see what you can see here. So there's the gross margin. Gross margin. Does anybody remember what the gross margin was versus an operating margin? It's kind of important difference, but really, to use the La Miranda sneaker company example, the gross margin would be, I sell a sneaker for $50. It cost me $10 to make the sneaker. So my gross margin is 80%, right? I'm keeping 80 cents on the dollar for every shoe that I get. It cost me $10 to make a shoe, and that gets subtracted. I make $40 out of the 50. That's just my gross margin. But so that's like on a per item. But then my net margin or my operating margin is my margin after I have to pay all my employees, I gotta pay for the rent, I gotta pay for my utilities. So the cost of just running the business gets subtracted then from that, and that gives us our operating margin. So you kind of see interesting things kind of pop out here where it's like, oh, Under Armour. Under Armour, its gross margin, and this is gonna be, any kind of like mass market fashion will kind of look like this, where your gross margins look really good because at the end of the day, you're selling some leather and nylon, right, with a name on it for like a really good price. So your gross margin is really good. But what happens here, their operating margins are actually basically zero, right? Why is that? What does Under Armour have to do to get you to buy their sneakers?
Market.
Advertisement.
Bang, bang, yeah, right. Who do they have to pay?
Stephen Curry.
They gotta pay Steph Curry, right? When you gotta pay Steph Curry $100 million a year or whatever it is, that's gonna destroy your operating margin. But that when you pay Steph Curry, that doesn't show up in your gross margin, right? Because this is like what you make per sneaker. But it's like after we sold all the sneakers, then we gotta go pay Steph.
Curry just left Under Armour.
He did just leave
Yeah.
Under Armour.
Why?
You wanted to go to
He's a-
Under Armour.
So this is so you
wanted
can.
to go to Under Armour?
So I just want you guys to notice the differences. If you look at these technology companies, you can kind of see why they've done so well. Their gross margins and their operating margins, they're really not that different. There's not, they're keeping a lot of the money that they make in revenue, right? Okay. So anyway, Liam, thanks for that. This was pretty cool.
Good job, William.
Okay, tonight, our game. These are the stats you are going to get. You are going to get these 7 statistics. Here's how it's going to work. We're gonna start in 2014. There's gonna be 15 companies. You're gonna get these 7 statistics about the 15 companies. Remember, those statistics are historical looking. And then what we're gonna do is you are going to pick your investments. Not just pick your investments, you're gonna pick how much to put in each investment in your teams. You're gonna have to sort this out between you. That's it, 1 laptop per team. 1 laptop per team. Okay, now you are going to invest, and then what we're gonna do is we're gonna roll the clock forward 3 years. So 2014, and we're gonna look at 2017, and we're gonna look what happened to all of your stocks. What happened not only to their businesses, but what happened to your return? How much money did you make or lose on each stock times however much you put into that stock? We are going to do this in four 3-year periods. So we're going to start in 2014, and we're going to come out right up to the end of 2025, and we are using real companies and their real data. But you don't know what the companies are. I've masked them, so you're going to see all the companies are named after local towns. Okay, so and this is, like I said, this is the only information you're going to know at every period. So in 2014, you're going to know these numbers. When we now in 2017, when you get to reallocate how you want to invest, you're going to get the updated numbers for 2017, and we're going to do that for every 3-year period for the 4 cycles. So that's how the game is going to work. Let me. Okay, first of all, before I change this page, does anybody want to look at that a little more and have any questions? I'll be while you guys are deliberating, I can help, but like, is there anything here that is not clear?
Is there a website to go to?
I'll get to that. Anything about the metrics? Okay. All right. Okay. So.
Like it.
All right. So let me. So where you're gonna go to. Listen, 1 laptop per team only. And it's really, really, really important. This is very, very important. You do not go to any other page except for the game page. Okay, just because like there's stuff that's on the other pages you're not supposed to see. So,
Yeah.
okay,
Zach, get off the other page.
Choose this one.
okay. Go to Notion. 1 laptop per team. Go to Notion.
We're on.
And you're all gonna be able to see the stats up here. So you're gonna be able to look up here. Go to notion.moontowermeta.com. Go to notion.moontowermeta.com. Yeah, guys, make room. Notion.moontowermeta.com. Then scroll down to the bottom of that page.
I'm already there.
Basically, you scroll down to the bottom of that page and click that link. What's that?
I'm there. My Wi-Fi just turned off.
What? Alright. Got it. Zoe, you have it?
Yeah.
Alright, everybody's got it. Great. Alright, cool. Alright, so you're only on that first tab. Alright, so now everybody can just pretty much look up here because it's going to be.
Wait, we're not on. Zach's computer doesn't work.
My Wi-Fi stopped working.
Are we T1?
Yeah.
Oh, sorry, yeah. The team, yeah, it was alphabetical, the team. So this is team 4 here.
T1.
Team
Can I
1.
change the name?
Okay, what's that?
My team said.
You can.
Wait, what?
Yeah.
Wait, can we change your team?
You can change your team name up in that cell.
Wait, what team are we?
What team are we?
I think you're team 3.
Okay.
Alright, so.
What is that team, bro?
Meat walkers.
Okay.
Alright.
Chase, you pick that.
No, we're team 1.
Nope. No, Tyler, stop. No.
Alright, guys.
say my neighbors so
Why are we called the meat walkers?
Yeah, like who named their team the Meat Walkers?
Nothing happened.
Okay. Is everybody set on their team name shenanigans?
It's
Gamers.
not tough.
Wait, Dana, what's your team name?
Okay. Okay, here's the rules. Here's the rules.
Team named the team one.
So, these are the stocks. Benicia down to Walnut Creek, okay? Alright. I'm going to reveal the metrics for these companies, okay? And then, hey, listen up. This is, so what you're going to, so this is, by the way, this is me, Benchmark. All I did is I, quit it.
I'm focusing.
Benchmark is, this is me equally weighting all the stocks except for I put 20% in like a savings account, T-bills. So you can put money in T-bills if you want. You can allocate to T-bills, and then you can put as much as you want in the different stocks, as long as you don't add up to more than 100%. Okay. So this is my portfolio, which is going to be equally weighted. 80% of my portfolio is equally divided between the 15 stocks, and then I have 20% in a savings account. Okay. So I'm going to reveal the metrics now, and then y'all can decide how much you want to put in the different stocks. All right. All right, ready? Okay.
No, you might be more.
I can't see.
Okay.
Wait, I'm
All right. So you can see the metrics up here.
It's not even funny.
Yeah, put it all in there.
Can you go back to the other? Mr. Chris, can you go back to the other slide? Actually,
If you need any, what I can do is if you need any help, I can kind of guide you through what they are.
slide about margin with the definitions of
Of the different metrics are? Yeah, so which is there a metric? So, here, let me,
I
said it by Oakland.
It'll make money.
Here.
Just ask
Let me-
it.
What's the EPS?
real quick. Let me go through the metrics just really quick. Revenue growth, because this is the first period, we don't know what it is. We don't have that. You don't know how much as the revenue's been growing, okay? Operating margin, we kind of talked about that. That's like how much you're keeping on any item that you sell. That's the $50 sneaker and you're keeping $40. That would be an 80% margin. This is your operating margin. Your net margin is after all the business costs come out after that, okay? EPS, that's your earnings per share, right? And then your PE. You guys, you remember for PE how to turn that into an earnings yield?
No.
Okay. If I pay, again, the example, if I pay $20 for something that makes $1 a year, 5%, how did you get the 5% reciprocal? There you go. So your PE, if you flip it in your head, you get your earnings, your earnings yield. This is your earnings per share for every one of these companies. And then this is your free cash flow yield. Okay, so your free cash flow yield is, if you think about it a little bit, like you have your PE, but then you actually give your free cash flow yield, which tell you how much, an example would be like, if you take one of these companies like Lafayette, let's just use Lafayette. It's got a PE of 30, right? So its earnings yield is what?
It's 130.
It's about, right, it's about 3%, right? And its free cash flow yield is only 2%, okay? So you have these different free cash flow yields, and you can figure out what the earnings yields are. This is one where this Oakland has an 8% earnings yield approximately, because it's got a PE of 12.5-ish. So it's got an 8% earnings yield, a 6.3% free cash flow yield. So most of its earnings is free cash flow and not being necessarily spent on investing or costs, right? So anyway, that's what the metrics are. when we roll the date to 2017's last return will get populated, and that's going to determine how you did on your stocks.
What are we compared to
So you're putting in
What?
think of your portfolio like a pie chart. Oh, I'm sorry.
We're not buying tea.
Concord is like.
Yeah.
Are you this?
Where's Zach Suck? What about
So
Martinez?
I'm so
you just put in the percentage you want to put in each company.
Oh, that's
No,
it.
look at there.
That's it. That's all you do. You just put in the percentage you want to put in each company. And every 3 years you're going to get
They're
a
not
change in percentages.
reinvesting. They're not gonna survive.
No, it's
San Francisco.
Okay, zero
Danville.
I'm bad with that.
No, Berkeley.
Oh.
Brentwood is
But I don't
zero.
Oh, I like Danville.
Yeah.
Okay, there's
Yeah,
very
well,
nice speculation about.
Yo.
What?
Danville's very
Yeah, but think about it. 10 years.
How do you figure this out?
Exactly. I think we should just take a shot because the jet
No, no,
Negative three.
Operating margin
yeah.
What does that mean?
Wait, it's called.
is the margin.
Where's this stuff?
Just the money. And then net margin is the margin they have left.
Yeah, wait, why is it called?
Yo, they're fried.
Oh,
We
because
are
they
not
have
investing in
they have no.
Concord.
Yeah, why? No, why is that?
Oh yeah, you know Concord. EPS is earnings per share. How much do we?
They don't even have it. They're reinvesting in.
Yeah,
Alright, wait, let's
no, that's fine.
Oh, be careful!
1%
Don't type in
just-
these
How
cells.
they reinvest in my shirt.
Oh, I don't know if anybody's just don't type in these cells. Only in these.
What are we doing?
Hey,
Shut up.
Does anybody not know what we're doing?
I think we should invest in Martinez.
What's up?
I don't know.
Okay.
Well, do you understand what you're supposed to do?
Yes, where do I put it?
Three percent in Martinez.
Let's go 5%.
3% in Martinez.
yeah, I like Lafayette to be honest.
They're losing money. Why would
But I like Lafayette because you
Yeah.
can see they have, compared to the operating margin, their net margin is pretty high.
Yeah, and Lafayette just Lafayette. We should just put 500.
Low
I
compared
think
high price.
Wait, do we put
And they have low FCF, which means they're reinvesting, so they're gonna grow.
Wait, let's split.
See what I mean?
No, I have no idea. What
Would you agree on Lafayette?
what should we put?
Wait, can we put like 1% in T-bill just as
the margins are not that good.
And what?
T-bill?
It's like I think 5%.
Okay, it's 5%.
No.
Wait, why are we only doing 40%?
How are you guys doing over there?
Each getting 25%.
Oh, I like that's a great move. I like that.
Wait.
I think we should put money in Oakland 14 and Lafayette. I don't like that.
Oh no, it's up there.
Don't put too much.
Martinez looks pretty good.
Alright guys, let's give it for Concord. Concord is on 0%.
No, put 1% in Concord.
No, 1% in T-bill. Oh, you're ready.
1% in T-bill. You want to see what happens?
I'll go Chris.
Yeah.
Low price.
No, what?
But high
They have no
It's like saying.
Oh, let's get like 5%.
Okay, yeah, put 5.
Wait, how many percent is that?
Which one
We
is
should
it?
put
Yeah, we have 100.
Yeah, it's
We should put 10 in T-bill so it can really high like a lot.
15.
Okay, so Dan.
Yeah, put 10 in
what?
T-bill.
It doesn't
10
show
in
it.
So
T-bill.
you say something like a steady.
We have
Alright, Brentwood.
Buy San Ramon. Get some San Ramon.
No, start at the top again.
No, we don't like this.
Scott,
That's a good
just earn. It has no positive. It doesn't have any earnings. It's earnings are negative. If earnings are negative, it's PE, therefore it would like not,
Then
doesn't make any sense.
like 10. We should put
I
some
don't
in
know.
That's
Wait,
free
savings.
cash flow yield
Look,
for
they
us.
have no
that's
debt.
good because they're reinvesting.
We should put some in savings.
Yeah.
We're going
Maybe next year.
from top to bottom.
But by the way, regardless of this one that's got these negative numbers, if you look at Liam's homework, Snapchat had negative numbers.
Guys, Richmond is.
So just, Snapchat has negative, does have negative margins.
Snapchat never. Hey, Sam, I'm only seen it.
Put 8 in
We
there.
should probably do like 5.
It just adds
Hey, what is
Free cash flow.
Negative.
But they're investing more money than they make.
They're reinvesting.
Yeah, buy Lafayette, buy Lafayette. Buy Lafayette.
What's 12 big?
12, yeah, 12.
You're losing your house.
We got 85% invested in Tiger in the Woods.
Oh, wait,
No,
it's
don't
over.
make money. Yeah, no. Yeah, good point, good point. 50, 50.
No, because I think we should put like a
I don't know what Daggers means, I'm afraid to ask, honestly.
Tell me what, look at me!
Yeah.
I don't like Moraga. Skip Moraga.
What is op
Oh,
mean?
that's the best stuff. I was gonna say, look at these kids.
What is op mean?
Alright.
Alright, so what Daggers is fully invested at this point.
It's like how much money they have to spend.
Go for the daggers!
Okay, Tiger in the Woods is 100% invested at this point.
Boys, I like.
Zach sucks, you got some more work to do.
Hey, that's
And Meat Lockers, more work to do.
Put some in.
We have 4 rounds, so let's
Do we have Martinez already? Yeah.
How much should we put in our?
Put an open. Put 15 in open.
that's op.
And then put some money in Orinda too. Yeah, put money in Orinda. Put money in Orinda. I like Orinda.
I
65,
can't do
look.
math. Oh,
Put money in Orinda.
Split those up, so do like one and a
No.
half.
Hey.
No, put some in San Francisco.
Yeah, put some in San Francisco.
guys, we're going down the list.
No, put San Francisco first.
Why?
Because it's hella cheap.
San Francisco and San Ramon.
Yeah, no.
How much?
And then.
Alright, Meat Lockers, last ones are waiting on you.
Chills.
San Ramon, how much do we have left? Put 15 in San
Oh,
Ramon.
it was.
What is
15
what?
San Ramon.
That doesn't matter.
Number one,
So,
It's the first.
they don't have any positive earnings.
Put 10.
Are you trying to do
Emoji.
PE would be incoherent.
San Ramon, 5.
And then it's free cash.
Guys,
It
only
has
one
free cash.
computer.
No, yeah, now,
I'm
I'm just
telling you,
questioning as to why it
confidence will go up.
why there's no negative number there, because we do have some.
Bro, they're in there, but 10 years, they're.
Look at Gagger.
We're millionaires.
Oh, yeah.
Okay, Meat Lockers, 5 more cents. 5 more percent.
Oh,
Put in
shit.
there.
No.
Oh yeah, Meat Locker
No, put
zero.
5, put 5.
Okay.
Daddy.
There?
No?
Hecka high investment for Martinez.
Yeah, no.
Is that how we go?
Okay. All right, everybody, we are 100% investing. Real quick, let's just say somebody put 20. Let's take an example here. Here we go. 20% in Martinez for Daggers.
Yeah.
Let's say that Martinez goes up by 30%. The stock goes up by 30% over the next 3 years. How much money are they going to make on their portfolio in percent?
A lot.
If they put 20% of their portfolio in something that went up 30%, how much did they make? I know you know. Hold on.
$300.
60%.
Let's do it in percent. 6%. 6%.
Yeah, 6%.
Right? They made.
Oh yeah.
They made.
A typical 1/30th.
No, they made 20. They made 30%. They made 30% on 20% of their total money, right? You got $100. You put $20 into something,
Oh, so it's
and it went up 30%, so you made $6.
just 30% of 20.
So, okay, when I hit the button, what it's going to do, it is going to populate all the returns for the next 3 years, and it's just gonna multiply the return per stock times your weight in the stock, and then sum it up, and it's gonna give you your portfolio return.
No.
So,
Oh my god!
We'll keep it. We'll keep it.
Nice!
What?
No! Wasn't it went down like crazy?
Yes!
so what happened?
I told you
Oh,
to invest
shit.
in Conquer.
Oh shit, Martinez, no.
No, Martinez will cook it a little bit. Trust.
Dude,
Martinez
what's
is
that
gonna
got
start
me?
walking.
You think it's gonna start going out?
Yo, everybody invested.
So,
Bro, Martinez is
I told you Conquer's good.
No,
More
David.
money in Conquer. More money in Conquer.
so it looks like it looks like it did not compute the round return, but it did compute what your money went to.
Oh no,
So-
they did do bad.
Hey, so who did the best?
Me, Walker!
$1,000
Us.
No.
Who did the best?
Me lockers are gonna
You did before. What did you make? How much return?
15K!
50%?
How much?
Is that 50%?
So everybody started with $1,000.
Oh, okay.
So how much? 63%. They made 53% on their money. How'd you do?
We all went up.
Everybody went up. That's a good observation. I want you to notice something. Only one team built the dumb monkey that just put the same amount in every single stock.
The dumb monkey.
The dumb monkey, right?
They did better than
Right? If the monkey picks the stocks and just says, "I'll take one of each," thank you very much. The dumb monkey did better than.
The S&P 500 is better at everything it's seen.
Uh-huh.
It's
Okay.
dumb.
But we're
Suck at
And the monkey had 20% in cash only, right?
Oh my god.
Well, good for the
You
monkey.
lost to the dumb
So, okay. So,
No,
I just want to double check, make sure that our metrics are.
Oh.
Wait,
Okay. So, okay. This is now look. Listen up. Listen. This is your portfolio values now. Okay? This is all your portfolio values. So the next period, your returns are going to be on these numbers. Right? Hey, real quick. Team 2. If you make 10%, how much money do you make in the next round? If you make 10% in the next round. This is your current portfolio value. Call it 1,300.
12%.
129.
Yeah, if you make 10%. So remember, now you're compounding. The next time you make money, it is on this bigger amount of money. You're now investing more money than you did the first round in terms of absolute dollars. Okay, all right. These are the new metrics on these companies.
Yeah.
These are the now look. Concord now has some numbers here, right? It looks like
Zach, could you
it's
please stop
getting
talking
its
about
act
it?
together.
Zach,
By the way,
please.
I want to
No,
point
don't
out
touch our name.
Concord
No.
went up 45% almost in the 3-year period.
I told you.
Concord went up 40, despite the fact that nobody. Two of you actually
We
put money in.
invested in that, we should change our stocks already.
Oh, okay. All right. So new allocations. Go ahead, put in your new investment amount.
Zach, please.
I say
Zach, I
no,
don't
we go with
appreciate
the
you
whole
taking
thing.
that.
We buy some Moragas.
By Conquer.
We ride the stock. I say we ride the wave of the momentum. What can we buy some Moragas? No, this is the return.
Negative 100 per week.
So,
Yeah, but
Wait, what's that?
I say 100%.
I say we
Oh, you just got more short stocks. That's how you show I like where your head's at, but.
Okay, this we did. I say
By Conquer
no.
and
What's
That's what I just took out.
One of them's gonna go up.
No, I can't see
15 in Conquer.
No, can we put some
You want to go in the middle?
Yeah, because I can't see.
Put 15 in
No,
Conquer?
I'm in San Francisco.
What's this investment all?
Yeah.
We just need to ride the wave.
Go big or go home. Let's go all.
0 and Brent. No, that makes how much
That might work. that didn't
Hey, wait,
attract
this makes
money.
no money. This makes no money.
You guys, what did
Okay.
Sacred put in hell?
Yeah, but wait, I think the
Confused.
other
We
ones,
like 2%.
This still makes no money.
and then the other ones we spread on.
Wait, can we
So-
want the
still
two
makes no money.
up a little bit and
Oh, let me
remove
see.
like more, like 10?
Now we have.
Oh,
Now we have now we
sorry,
have
you're right.
20% to allocate.
Delete some from.
Alright, guys.
Because
From
Benicia
no, we
is-
didn't write the monogamy.
Put 10
I
in.
just
No, he said it's minutes. Or we could do
Yeah,
minutes.
Take money
That's
out
it up
of.
there.
Open.
No, that's it,
Unlike
that's it,
open.
that's it. Oh wait, we're
Put
We're
some
selling
in.
open.
Hey, did somebody?
Seven
Hey, so
o'clock.
where do we have money? Let's look at the numbers now. Why do we have nothing still in our index?
Sorry.
We need more in our index.
Oh.
We-
Yeah, I don't know.
It's been trash.
Sorry, Benicio is hidden.
We're riding.
No, put 5. Alright.
We're at the slide.
Meat lockers, you can't have 137%.
Yeah, we're selling
Come on,
right
meat
now.
lockers. Okay, I think we're ready.
We're
We're
selling.
selling right now, yeah.
We're gonna check, we're gonna check.
New strategy.
What did you do? No, guys, this is called
No, 'cause
like you
you
closed
see
the whole
how-
thing.
Yeah, just put it all in.
Well, let's get the numbers to 100% each.
Guys, stop putting 67.
We gotta pick up the pace.
Yeah, come on.
I'm done.
Spread it fast.
We're done.
Meat lockers, you gotta.
Meat lockers, come
Take
on.
$2 out here. Take $2. We don't need the 2%. Double it.
In hunger.
Okay, ready.
You gotta spell
Wait,
my
wait,
No, no, no.
Figure out what's what.
Maddox, you
Figure
gotta
out
spell
what's
my
that.
whole name.
Okay.
It's unfair.
Actually,
No, we gotta hit it until they're.
They're
we're
taking
turning
a load.
into 50.
This isn't fair.
Okay, we're
No,
taking
we're not.
it.
We're
Okay, ready.
Done it.
All right.
Please.
We win. We win. We win games.
Let's go positive.
I told you.
Oh, Martinez.
I called it.
We're Martinez did so
I
well.
told you.
I'll make it.
Please, Jeremy,
Slow
slow down.
Come on, meat lockers. I told you.
Okay, so what drove? Because Concord went up 98%.
I told you to go to San Francisco.
Does that work?
That works.
They went to
Bro, Concord.
We can sell all the ads.
Bro, team one is fried.
Team one,
All the ones that are
We're so
negative.
you're the smartest person.
All right.
All the ones that go in
Alright,
These
okay.
kids are still losing.
All right. Round 3. Go ahead. Round 3.
Slow it down on Concord, but keep it on
You gotta
slow.
sell 20.
Only- Now we have the big swing, and now we keep focusing on what. Wait, team one?
Add like 25 there.
Or is the team?
Walk me through selling in New Jersey. Bro, the T-bill cooked. Yeah, I told you that.
We're doing- no, I didn't know if you were standing up.
No, the T-bill
I don't know what plus
Was it no rebound?
No, 20 and Renzo rebound.
All right.
Render just flatlined. No. It flatlined.
Wait, we did a statement. What is that?
Boys. Put 20.
And then,
Stop copying
Yeah, 30.
Wait, can we pull up 10?
Now let me know when you're ready.
Trust me.
Who's not ready?
Wait.
We got it.
Wait, guys,
We're done.
We're done.
Can we put negative?
Oh, yeah.
Okay, we got it. We got it.
No, don't put negative.
Oh, we're gonna sell Benicia.
This is a
No, but if you put a
share.
lower quantity or 0, then you have sold it, right?
Growth rate.
You're no longer own it, so then
Wait,
you
what
must have
about
sold
the
it.
Guys, we want to
That's,
sell it. We have
no,
no
no,
way to
Basically,
make
that's
money.
profit. That's your
Oh, that's
full
shorting.
profit margin of profit.
That's next time.
And then
Is that a good trash?
net
Yo,
margin
like
is after all
Benicia.
the expenses.
Right.
I haven't stress tested
the
the spreadsheet.
We went up the road.
All right. Is everybody done? Okay, I'm running it. Yes?
Yes, it's
All right.
Yeah, I know you.
Best food stuff, not the T-bill.
All right. Round
Never do
3.
T-bill. Wait,
What about
no, wait. Put
last-
five
Run it.
five,
Yes!
five in here.
All right, what happened?
Oh,
Nice.
Whoa! What happened here?
Scroll.
Look at the other
Wait, no,
people.
we don't know.
What? Conquered.
we conquered.
That's what Google.
No, this not gonna go well. You can't.
No, I don't think that's smart. No, because now we see it. The trend is going very high. And on the probability of it like lowering or falling.
Timu, bro. It's gonna just stay high.
I like 20 or 30
Yes, yes.
conquered.
No, guys.
Well,
I'm
it's
wrong
a-
on this.
it's
I'll
a
do
little
it.
bit like,
No, SF's
we'll
goal.
talk about it after the executive.
Oh God, I can't.
We'll look at it after the
If I'm wrong,
But yeah, Berkeley was
Right.
like against
a lot of
you're
this.
100.
Put 30, no, 25 and conquered.
A lot of this, you saw some versions conquerors had all
Put
this
20
bad
only
numbers.
conquered. Put 20
The stock's doing great.
Guys,
No,
listen,
the point is,
guys,
a
listen.
lot of places, like,
It's
the numbers are getting knocked in half. So it's really about the story of the future.
There was so much volume in conquered right now.
Something that's future has been encouraging. What I don't know is Concord
I'd be a
has no
millionaire.
reason to now has
Yeah,
a
do
dollar
that
share.
quickly.
50-50.
So you can also see, although it's interesting is,
Hear me out.
What goal will be in that?
is,
No, check out.
And what?
Put some
but look what's happened.
Beef Southern Danville and Beef Chicago.
BCCR was $1.
So
The revenue has actually not grown in the last period, right? Now granted, a lot of stocks, revenue went down. But what do we know about the period from 2020
what
to
is
2023?
fluctuate? What does that mean?
That was this period.
There was no stock.
Hey, listen.
Hey boys,
I want you to notice something.
Pleasant Hill.
I want you to notice
Yeah,
something.
listen to
The
this.
revenue growth on a lot of these companies in this period, several of them, was negative.
Damn,
Negative.
Berkeley.
What is special about this period? This is 2020 to 2023. COVID, right? So a lot of these companies had negative revenue in this 3-year period, right?
Everything in T-bill.
Well, look what happened. Look what happened to Concord.
100% in
Richmond
T-bill.
and
Its earnings at the beginning of the game were 0 per share. It's only $1 per share, but look at the multiple.
We saw the potential. We saw the potential.
You saw the potential. Right?
Don't keep putting it in this
All right.
next
Is
Amazon.
everybody ready?
Yes.
All right, you gotta.
Conquered is it?
Just a big nut. Just a big nut.
Wait, I'm gonna remove 10%.
No. I say buy more Richmond and Pleasant Hill.
Yeah, listen to him. Listen to
Buy
this
like-
guy.
He's smart.
Alright, are we ready?
Yeah.
Y'all ready? Just leave it. Just leave it. Just leave it.
The Jackets are ready.
Let's go!
We need Lafayette. Lafayette all the way.
Lafayette. I can gamblers, bro.
1 in 15 that no one.
Oh my god, they can go.
Okay, revealing last round.
Hell no, we have an each other.
This is 2023 to 2026. What happened?
I'm scared.
Lafayette, boom.
Open shut.
Boom!
Oh!
I saw it.
Okay.
46. I
Come on.
No, we shouldn't have put it in
There's
there.
a hard to 300.
We shouldn't have
What
put it
happened?
in
Wow.
Dude, and we just went all in and conquered. We would have gone up 300%. Why did you listen to me?
We beat benchmark.
It's Amazon.
No, it's Nvidia. No.
Why didn't you listen?
All right.
I'm gonna have to
Okay.
do the
So first of all, just so we don't understand the
Tiger
numbers.
in the woods.
Team 4 made 13 times their money, right? We started with
Gathers in
$1,000.
second
They
place.
now have $13,000.
I told you they're
So how many times did they double?
It's okay,
in,
bro.
12 years?
13 times.
No, how many did they double in 12 years?
Around 300. 3 and 4, all of it.
Between 3 and 4, right?
All of it
Okay.
on Concord.
Uh,
She's gonna keep going up.
For those of you in high school math, it's log base 2 of 13, right? Okay.
For us.
Between 13.
Yep.
Okay.
Yeah.
So, all right.
Like we're putting
So,
all of it into Concord. Like
Okay.
no,
This
I'm
is-
totally done. Put all of it.
Still one.
13 extra money.
Oh wait, we're
Uh,
we got double.
Who, let's see.
We got double.
No.
There's not enough. There's not enough like.
You know what? Let's,
We do
There's not enough like.
We were the most consistent.
somebody.
I wanna see
guy
one
who's
that
the
fits
most
you more.
Gotta mess with something here, right? Is that was.
Wait, can we do one more
Stop,
round?
I
guys.
think we
Okay.
won.
All right. Let's show what the companies were.
Fulgaggers on top.
Fulgaggers was the most consistent.
All right. Let's see what these companies were.
Yep.
Reveal unmask the companies.
Lafayette was
The Masked
Under Armour.
Singer.
Benicia.
Tesla.
TPS. Costco.
Tesla.
Sorry,
Okay,
sorry.
Tesla.
Oh, we should have done SF, bro.
I told you SF.
We should have just done. You said the
Boys, it doesn't matter. We still won.
So here's what the companies were, because you might not know.
We could have done better.
So Benicia was the Gap.
Benicia-
The Gap. Costco.
Domino's.
Starbucks.
Oh.
Tesla. Tesla. Did anybody notice how expensive Tesla
Domino's.
stock is? Right?
Are we kidding?
Netflix.
Oh.
Lululemon.
I told you
Chipotle.
that's where we put our money in.
Chipotle. What's
Domino's.
Domino's.
All
easy.
my money is Domino's.
McDonald's.
Yay.
Ulta Cosmetics. M is.
Oh, I said for Richmond. What was Richmond?
You know what?
Manly.
Oh, Macy's.
Yeah.
This is Macy's.
Low key.
I told you guys to put money
I think that's Lowe's.
Yeah.
Nike.
No.
Amazon.
I told you Amazon.
I told
Target.
you Amazon, bro.
You said Amazon was
And I
Concord.
think the way I
I
did
told
this
you guys.
is I think that the size of the company, the value of the company, the size of the company was in 2014 was mapped to the size of the city. That was between. So, all right, we can talk real quick about.
No. Can I move back to my seat?
Yes, you may.
Take your
Oh,
jumbo.
it's speech. I'm moving back.
All right, so this was the.
Oh, I can sit on your
We don't want you here.
Never.
Here's the performance of the various companies ranked, right? So Concord was Tesla, and it was the best performing stock. But what I wanted to point out was why these stocks did what they did. It's not because Tesla's earnings per share went up a whole lot. It's because its multiple exploded to a crazy number. Its earnings per share started at 0 and was $1 just 3 years ago. All of its growth is because people just keep paying more for it. It's not necessarily because its earnings have been fantastic, right? So, but you can see that just on that alone, you can make a ton of money on a company, right? Danville started with a really high PE and near 0 earnings. Its PE collapsed, went from 200 to 30, but its earnings per share actually did go up. So people expected that Netflix was going to make a lot of money. It did. People now don't think Netflix is going to grow as fast as it did before, which makes sense because at this point in time, everybody's got a Netflix account. Where's the growth going to come from? Right?
The new generation.
Amazon we talked about, its PE stayed about the same. The multiple stayed about the same. All that happened was earnings, like we talked about, exploded, right? That drove its return. Costco, both things happened. Earnings went up and the multiple doubled. So this alone contributed to 100% return on the stock, and then its earnings grew as well. So you get an 800% return on owning Costco. Domino's
My favorite.
earnings, this company's making a ton of profits, right? And its PE ratio actually was about the same. Didn't really do much. All of Domino's growth has actually come from the business being really good. Orinda, same story as Domino's. Ulta is making lots of earnings. It's not really because the multiple's going up. we're having that in a lot of companies. Lowe's, same thing. Companies that are like really making and growing their earnings quite a bit, and their multiples are staying about the same. So
They didn't earn stuff or they just
that was anything interesting here. How about Lululemon? Because that's Lafayette. We like that one, right? So earnings went up quite a bit. Its multiple fell. So if your multiple goes from 30 to 20, that makes the stock's return fall by a third, but that was offset and a lot more so by the earnings going up by 6x, right? Because it went up 500%. So that's Lululemon. What were the stocks that did bad? These old retailers, right? The Gap. This is over 12 years. Gap has basically not done anything in 12 years.
Isn't Macy's?
And Macy's has lost a third of its value in the last 12 years.
They're going bankrupt.
Right? And notice something really important. Macy's was the cheapest stock in 2014. It had the lowest, meaning it had the lowest multiple. The market knew that this stock was cooked, right? Like, people were not willing to pay a lot for Macy's. So it was the cheapest stock, and it was the it ended up truly being the worst performing of these stocks. And here's one, I think, another one I just want to point out. Nike's earnings have actually fallen over the last 12 years, but its multiple has increased, so its total return has still been somewhat positive. Real quick, if you double if you made 100% on your money in 12 years, about what was your annual return? Anybody do that?
Wait,
Anybody can do that?
how many years?
12 years?
12.
Hunter.
For which one?
If you doubled your money, let's call this double. If you doubled your money in 12 years, how much did you make a year?
6%.
Rule of 72, right? You made 6% a year, okay? So, we kind of went over this, like what drove the different returns, but I really wanted you to think in terms of just 4 categories, right? You have companies where the earnings growing was what drove the return. And then you have companies where the multiple, the sentiment around the company, the expectations of its future got more positive. That could drive the return. And then you have these situations where both of them work. Both the earnings grew and the optimism also grew. So right, this is like a double kicker. And then this was a situation where the earnings fell and the stock fell. In some cases, the multiple grew, or actually, I don't know. Yeah, the multiple actually grew in some of these cases. So these are like sort of, this is like, there can be ambiguous cases. Earnings grow, sentiment falls, and vice versa. And then there's like where everything works and there's where everything goes bad, right? So it's a 2x2 grid, okay? And every one of those stocks can fall somewhere in that grid. Okay, and then this is just at the end of the slide. This is just like a glossary of the different terms we kind of went over, and that's it. I mean, it's